you have a $250,000 capital gains tax exemption on your primary house. One question that comes up all the time around selling a house is, what are my taxes going to be? And how do I figure them out? Well, today we're going to get into it and show you how to calculate your taxes and how to have maybe as much as zero tax due when you sell a house. Let's get into it. Now, to be clear, like, I am not a CPA. I am a residential realtor with over 1,100 closings and over $500 million in sales volume. And yet, way into the process, we get into conversations about what are my taxes going to be. I'll never forget one of my first transactions that I was doing. I was actually personally involved with my grandfather, who was a many decade long-term lifetime investor, and we were selling one of his first properties. In fact, for the balance of his life, he only sold 5 properties, and I sold 4 of them, and which was a great honor in my life. But we were under contract. We had a great deal going, and I'll never forget that he was this, full-on adult figure in my life, inspirational person. And the next thing I know is he's like, "Hey, what are we gonna do about the taxes?" And I was like, "You don't know?" You're asking me? I'm like, I don't know. I just started doing this. So and so that's why we're here today, to talk about the taxes on when you're selling a house, and whether or not it's your primary or whether or not you've owned it for 2 years. All of that has direct impact on the amount of tax you'll pay and the different codes that exist in the tax code. Now, by no means are we going to tell you how to cheat or to do anything like that. No, by no means. However, one of the things we are going to do is to share some of the rules and some of the qualifications you need to have as little tax due as possible, and the rules that are out there so you can make decisions. We see people make mistakes all the time, that they were just a few months short of having a huge tax savings that could have saved them thousands. So that's the kind of stuff we're going to talk about in the video today. Glad you're here. Let's get into it. So how do you calculate the gain? That's the first thing that you got to figure out, is what is my gain? And that's what's going to be taxable. And so you want to go through, and it's the sales price minus the expenses of the transaction. So that's the first part, is how to calculate the gain. Again, make sure you're working with your financial professional to make sure you're getting all of the things, but we're going to share a great tip right here of maximizing and getting as much gain out of this as possible, and much tax optimization as possible. So you want to make sure you use the sales price minus all of the expenses. That's commissions, that's closing costs, that's repairs that were done throughout the process. But here's the one that gets overlooked all the time, and it's actually whether or not you should use a credit in your negotiations around repairs. Now, we believe this is one that you should do, as opposed to paying for repairs out of pocket. Use some of that equity. First of all, it hasn't been taxed as ordinary income. But second, it's coming out of your equity, and you don't pay it unless it goes through, to closing. So there's a double bonus there by doing that. And then it's an expense of the transaction. So not paying double taxation, not paying capital gains on that equity that you have, and you have an extra security blanket when you're doing a credit, that you're not going to pay for something that might not be used in the event that closing doesn't happen. So you want to make sure that these are things you're thinking about when you're optimizing your taxable gain in a sale. So next, you have to figure your adjusted basis. Now, what that means is your purchase price, the price you paid for it when you acquired the property, plus any improvements you've made to the property. That could be a roof or a central heat and air, or a complete, primary bedroom and bathroom remodel that you've gone through, or an addition that you've done. All of those things can be additions to your adjusted basis that helps us get to calculating the taxable gain that you get to. Because some people, one of the biggest mistakes we see people make is like, this is what I owe, this is what I'm going to make, and they think that's their taxable gain, and that's just not accurate. There's actually all these different calculations and expenses that you're recapturing over your time of ownership that you want to be strategic about. So that next piece is the adjusted basis, what you paid for it, plus all of your improvements. Did you do a roof? Did you do several new central heat and air systems? Did you add a home generator system, or, like you say, a significant remodel. All of that goes to your adjusted basis. Now that you've done those two calculations, you put those two together and you take your amount realized and your adjusted basis and subtract those. And that is actually your taxable gain that comes to the equation. Again, we've talked about people tend to do the bigger equation and it's typically wrong. And so you want to go through here and really be intentional about what that is, whether it's a gain or a loss. Then you start to look at, can you optimize on this, and looking at certain parts of the tax code that are out there. Specifically, when you go through and there's some exclusions around 121 in the tax code of a primary home sale exemption. Now, this is one that's not often talked about, using this tax code on your primary home sale exemption. So first of all, it depends on if you are single or filing married and filing jointly. Each different one of those, it's if you're filing a single tax return, you have a $250,000 capital gains tax exemption on your primary house. Now, here's a really cool fact. It can be a house that you lived in any two of the previous 5 years. Now, isn't that interesting? Any two of the previous five, they don't have to be consecutive. They could be year 1 and year 5. It could be year 1 and year 2. And then you rent it for year 3, 4, and 5. And that's a tactic that we share with our clients all the time is, can we rent this and have someone else pay on the debt, for another 3 years, pay down your debt, pay into your savings account, which is your equity on that property, and then let's sell it in a few years. I have multiple people that we will go in and do a 2-year lease or even a 3-year lease with some rent increases over time, and then they get someone else that pays for it actually longer than they did. So that's a great tax strategy that you move, every 2 to 4 years, and you keep moving because you have that taxable, advantage and exemption on your primary home sale up to $200,000. Filing single or married filing jointly, you have up to $500,000 capital gains tax free. So now that we're talking about the primary home sale capital gains exemption, there's two requirements that you have to meet. You have to have owned it for 2 years and you've had personal use for it for 2 years in that 5-year window. Again, you want to make sure your real estate professional has given you advice around that. If you've got an investment property that you owned and you lived in and it's now become a rental, you want to be having that conversation in year 3, 4, and 5. Should we go ahead and harvest this, because you're going to miss this exemption and this opportunity once it rolls into year 6? And it may be a good performing asset and you want to own it forever. But we have different reasons at different times for selling things. And so this is one that we get into and want to talk about. Like, hey, is this the right time? We're on year 4 or on year 5. Do we want to go ahead and do this and recognize and get that equity out and do something with it? Or do we want to go ahead and roll it into the portfolio? So you just never know, but make sure you're having that conversation and checking the market. If you don't have a financial professional, you can reach out to us and we could connect you to one of our partners in your local market that can do an analysis for you, and then you can make that decision. But hopefully you've got someone in your life that's guiding you as a real estate professional and treating you like as part of your financial advising team. So what happens if you don't qualify for that primary home sale exemption? Well, again, as we've said, we're not giving you direct advice, but talk to those financial professionals. The variance could be gigantic. It could be as much as 10 to 37% tax on that gain. Yep, 10 to 37% tax, depending on a couple different variables. And there's so many different variables. We're not going to go into it today, but we're going to actually ask you and direct you that if you don't, but there are still opportunities to optimize your taxation on your gain that you've had when you're selling this property. Again, it depends. Is it investment property? Is it a former primary? And the use, and then ultimately the ownership is really important around the qualifying. How long have you owned it? And then what was the use of it in that time? And there's a couple different variables. Again, the variables are infinite. If we have 4 or 5 different variables, there's like 1,500 different outcomes across those. So it's just too big to go into today. But if you do come across that and you don't hit one of those on the primary, make sure you reach out to your professional. So it could be that you actually decide, hey, it's been 18 months since I've owned this and I've got a good opportunity to get a great gain, but you actually probably should go under contract, but actually time the sale not to happen until a week or so after that 2-year horizon. And that one tactic alone could save you tens of thousands of dollars when you're selling property. So just make sure that you're going through and looking at all those optimization. It's funny, we don't really run into this. You don't see a lot of people talking about it. That's why we're shooting this video and sharing it with you. So listen, if you found some value in this, help us out. Change that subscribe button from red to gray. Drop us a comment, send us a note, because we love sharing great content like this. And when you do that, it helps us connect to other great people just like you that we can help in our market and across the world. We actually had a referral go out across into London earlier this year, and even just across the United States. We had one go to Park City this week, and we've had one even going into more local micro markets in our region. And so we love making those connections with people that we actually know, and that's how we can help you have a smoother real estate process. So let us know if you got some value from this. Let us know what your thoughts are in the comments, or if you had the experience where you wish you'd been a little more tax optimized. But glad to be sharing this one with you. Hope to see you out there soon. And until we connect again, my name is Alex, and I'm your friend in real estate in Nashville. Keep on keeping on, and we'll see you soon.